The following is a production of Professor Robert Barnwell. Each episode includes insights provided by the chairman, CEOs, and CFOs of the world's most successful corporations, as well as thought leaders from premier business schools and international consultancies. If you and your team would like more information on corporate leadership and strategic management, or would like to learn more about Professor Barnwell, his research, and how he may be able to assist your company, please visit Professor Barnwell's website at robertgbarnwell.com.
Hello, and welcome to CFO Talk Radio. I'm your host, Robert Barnwell. During the last episode, we spoke with Wharton School of Business professor Larry Rabiniak about the concerning rate of failure for strategic initiatives and the important role of the CFO in strategy development and execution. This is episode 6, and we'll be joined by Booz Company partner Justin Pettit. Justin is the co-author of a recent Strategy+Business article entitled Making the Most of M&A. In addition to his vast mergers and acquisitions experience, Justin is also an expert on the intersection of finance and strategy, value-based management. In a departure from our normal programming, we've asked Justin to join us for 2 concurrent episodes, which will also appear on our companion program, CEO Talk Radio. So Justin, welcome to CEO and CFO Talk Radio.
Thank you, Robert. Thanks for having me.
We're really happy to have you here. And in fact, not long ago, we were fortunate enough to have RSM McGladry's Bill Spiesman on CFO Talk Radio to discuss international M&A transactions and due diligence. And, I thought you and I were having a telephone conversation not that long ago, and I thought, it'd be nice to have Justin on to share his thoughts on maybe the broader M&A market from a North American as well as a global perspective, and maybe to identify some of the key stages of M&A transactions. And in fact, not long ago, I think it was Business and Strategy magazine, was it not, that you published an article that covered that topic?
That's right. Strategy+Business is a journal that Booz sponsors.
Great. So I'm wondering if maybe we could talk about that article and then maybe update the market on what's happened since and what you think that the M&A market is likely to look like over the next couple of years.
Okay, sure. Well, at the macro level, we're seeing 4 factors contributing to what we believe will prove to be a period of significant M&A activity over the next several years. First, the credit crisis is now behind us, and so uncertainty no longer dominates the financial landscape. Investors have been adopting greater proclivity for risk, and that's evident in the rebound of the equity market, as well as a tightening in corporate bond spreads and the reopening of new issuance markets. Secondly, stock prices are up, certainly, and that's thanks in part to robust corporate earnings. But also, much of the gain is attributable to cost cutting as opposed to top-line growth. And, productivity gains are good, but ultimately investors are investing in stocks looking for a growth story. And these expectations for growth are already capitalized into stock prices. Third, the balance sheets are now well-mended, and corporate cash holdings, in fact, are at an all-time high, more than twice their historic levels, and debt has been paid down. So executives are keenly searching for ways to put this capital to work. And then the fourth factor in all of this is that the lull in M&A activity through the period of the crisis has translated into a tremendous pent-up demand for deal flow by all constituents, really. So that's at the macro level, those 4 factors. But then also within each industry vertical, there will also be many specific factors. Things such as in the energy sector, you've got keen interest in shale gas plays. In pharma, there's a scramble to backfill revenue cliffs from patent expiration. And in tech, of course, we saw with the bidding wars between HP and Dell, everybody's searching for storage assets to be part of their cloud strategy. Okay.
So all these things sound promising for M&A transactions. So I think it'd be nice, to maybe talk, to go back to the article and talk about, the M&A process and the individual stages for M&A. So why don't we talk about the first stage that led up to building the pre-deal business case for a transaction, and what the new market realities may mean for the type of questions we need to ask ourselves.
Okay. The ultimate questions are going to vary a little bit by specific industry, but let me start with an example of a live case, something I'm working on right now, and I'll embellish a little bit on that first stage. But the company that we're working with we're helping to evaluate potential entry into the North American unconventionals business, shale gas. It's a relatively new but very hot topic in the oil and gas industry. And new fracking technologies have enabled the extraction of previously uneconomic hydrocarbon reserves. And these reserves are proving to be very, very large and domestically available. So it's an interesting play for a lot of folks. The first stage of that process is really developing the investment strategy itself. And there you're employing fundamental analysis of supply and demand, price, technology, regulation, competitive dynamics to formulate that investment strategy. And that would include not only organic investment, but also acquisitions or collaborative deal structures like JVs. And in the new market reality, especially in energy, where bid-ask spreads have just gotten so wide, JVs are often the only workable deal. The sellers are still looking at some of the old historic price anchors, and the buyers are looking at where things have gotten to more recently. And JVs end up being something that, in many cases, are the best way to get some kind of a deal done with some of these upstream assets. Second stage, then, is the target screening itself, compiling the list of potential targets that are both attractive but also actionable. And I think in many cases, folks forget to think about the actionability of a deal, whether the seller is actually willing to sell or if there's some reason why they might want to sell. And then developing client-specific criteria to evaluate the targets. And in the new market realities of today, I think it's important, especially in energy, for buyers to find a reason why they can afford to be the best bid on an asset, other than just simply willing to pay the highest price and accept the lowest return. Third stage gets to building that business case with hopefully compelling economics and, more importantly, the strategic rationale for the deal. And this strategic rationale is hopefully what's going to give rise to the reason why the highest bidder is the natural owner for the asset. And so back to the case that I'm working on right now, for them, security of supply is a strategic rationale. Now, in a long gas market like today, there's a glut of supply. They could simply procure feedstock in the open market, and that could be their operating model. But if our fundamental analysis highlights potential gas shortages, let's say several years out into the future, say due to switching of coal-fired power generation toward gas-fired generation, then there could be a day when a simple procurement model comes up short, and they need a better way to secure supply. Hence, potentially the need to do an acquisition or maybe a JV.
Okay, so the senior team they've huddled up together and they've taken a look at the M&A market, recognized the reality, and they've come up with a set of an investment strategy and maybe some deal screening criteria. And then in the next stage, you discuss strategic due diligence, and I really want to emphasize the word here, strategic, in contrast to maybe traditional due diligence. And can you, kind of quickly take us through, what is the difference between strategic due diligence and the more traditional legal and financial due diligence process?
Okay, I can hopefully get you a shorter answer this time. But strategic due diligence, as you said, it's not the traditional review of tax, legal, and accounting issues. That's the domain of the traditional due diligence. What it really is it focuses on, well, what do we need to believe for this deal to be successful? And it's understanding the economics of the business case, key inputs and assumptions, and then playing with the key inputs and the assumptions over the relevant range. So doing a sensitivity analysis over the relevant range for those variables to understand the profile for the economics over a range as opposed to a point estimate, and making sure that each of these key value drivers is thoroughly tested.
Okay. Now, again, going back to our last telephone conversation, you and I think, despite having been in the world of finance and strategy for, I think over 15 years in both of our cases, we're still shocked at the amazing failure rate of M&A in the market at large. If we're looking at long-term value, we've already talked about improving strategic business and financial returns, but other than the valuation and the actual negotiated purchase price, I think that very few of these points carry as much weight in terms of long-term value creation as does post-merger integration. Do you agree with that? And if you do, what can companies do to better plan for and execute the post-deal integration?
Yeah, roughly the study that I've done myself and most studies in the literature come in with similar finding. Roughly half the deals fail and half the deals are successful. And the disparity in the literature tends to come right down to whether or not they're doing an arithmetic mean or a geometric mean, because there's some very, very large telecom deals that skew the data downward. So roughly a 50-50 chance of a win or a loss. And then interestingly, if you go, say, 1 year post-deal, most of the data is actually quite skewed to the tails, which means that they're either very successful or very unsuccessful, not a whole lot of middle ground. I would agree. I think in many cases, it's not because the deal was a bad idea. It's not because it was too expensive. Certainly those are factors, but in many cases it's simply because the execution was poorly done. And so that gets us to the final stage of the deal around post-merger integration. And this isn't simply the organizational architecture, the lines and the boxes that get so much focus during integration planning, but also other aspects of the organizational design, such as the roles and decision rights, management processes, incentives and rewards, and also the informal organization, things like culture and how we define a win within the company. For example, ExxonMobil paid roughly $40 billion for XTO, price we can all quibble over, and for reasons that we could all quibble over. But ultimately, the success of this deal is going to hinge on how well Exxon is able to balance their own need to integrate in order to build their organizational capabilities in the unconventional gas business, with XTO's need to remain independent in order to preserve their very different culture and operating model.
Well, terrific. Thank you for those insights. Well, today we've been talking with Justin Pettit, a partner at Booz Company, about his recent Strategy and Business article, Making the Most of M&A. Justin, I've really enjoyed our talk, and I look forward to speaking with you again next week about your thoughts on value-based management. Many thanks.
All right. Thank you, Robert.
That was Booz Company partner Justin Pettit, discussing the current mergers and acquisitions market, as well as his recent Strategy and Business article, Making the Most of M&A. Please join us for our next episode when we speak with Justin about value-based management and why shareholder value metrics still matter. Until then, this is Robert Barnwell and CFO Talk Radio wishing you all the best.
We hope that you have enjoyed this episode and found the material of value. To download a transcript of this episode, receive a free subscription to the show, or to learn more about this subject, we encourage you to visit Professor Barnwell's website at robertgbarnwell.com to explore the many executive briefings, presentations, case studies, and other resources available for immediate download. This has been a production of Robert G. Barnwell. All rights reserved.